Crypto King, we back. I'm feeling good because I'm getting too much money. Got too much money. So, the market went up crazy this weekend, and I'm feeling like $1,000,000. I think I might give away $1,000,000, but I ain't got it, so don't quote me on that. So, today, we're gonna get into this crypto because it's got me feeling good, and I hope it's got you feeling good as well. So without further ado, we're going to react to some of the other financial creators and see what they're talking about. So without further ado, shouts to MTR.
Welcome back, babes. Our Bitcoin price prediction from yesterday's Sunday live stream at 10 a.m. PT has aged immensely well. Money is flooding into the Ethereum ecosystem, and Ethereum is on an absolute tear. Plus, we can expect to see crypto regulation coming into play via the UK and Russia. Plus, Biden's sneaky new tax bill was just announced this morning. I wonder what mainstream media news took the spotlight last night to cover this sneaky bill. Let's get into it.
Let me check on something real quick before we get started, just to make sure everything is looking good and smelling good and feeling good. Because, okay, that looks good. My bad, y'all. Back to scheduled programming.
Make sure to follow me on Twitter, TikTok for breaking crypto news. But this story here from Being Crypto, over $100 million in Ethereum positions liquidated in the past 24 hours. And it looks like over 62,500 traders were liquidated. So basically what that means is it means that a lot of people were short when the market was bullish and they were not practicing risk management. Always make sure to practice risk management. Also, over $400 billion enters the crypto cap in 30 days.
That's billion with a B. I appreciate y'all for investing in what I'm investing in.
As the global economy dwindles. We're going to talk a little bit more about Biden, inflation, and global economics in a bit. But first, let's take a look at this over here. It shows that Ethereum has been trending on Google Trends. And we can actually see a bottomed out area here, March 13th to 19th, and we're starting to run upward. This is good. This means more people are interested in cryptocurrency and Ethereum. And it is also showcased in this CoinDesk article. First mover Americans, Ether hits 2.5 month high as Google search shows peak interest in Ethereum merge. This basically means people are searching Ethereum, they're interested in the ecosystem, and they're getting excited about it. That means number go up. When we take a look at price here with Ethereum, our lines have played out immensely well. We're actually above the EMA 200, which is absolutely beautiful.
Y'all comment if y'all want me to do stuff like this, like with the chart and stuff. I really think it's unnecessary. I don't think you can predict the future based off of the past. Like a lot of I watched it was a TikTok video where the guy was like, it was a wealthy guy, millionaire guy, and there was a young intern trying to go in and explain to him like, oh, the chart, it does this and that, and based on this pattern. And the rich guy looked at him dead in his face and he said, if it goes up, it's going to continue to go up. If it goes down, it's going to continue to go down. All that other BS stuff that y'all be doing with these charts be interesting to me. I don't pay it. If you're a long-term investor, you don't really got to pay this no mind because no one predicted the Rona. You know what I mean? And that crash. So it's like, certain things happen between crypto and stocks and stuff like that you just can't predict. I remember I was invested in Chipotle when the E. coli thing broke out and that dropped and I used to eat Chipotle all the time. So that's why I was an investor in it. And yeah, it is what it is.
Beautiful. Once we successfully get that bull cross with the EMA 9 above the EMA 200, it is full send. Right now, what I'm looking for is a sustaining over $3,200 to approximately $3,100 because we've got some strong support here at the EMA 200. If we can do that, our next target will be $3,800. And I'm 100% here for it. I've got quite a bit of Ethereum. Now, talking about Bitcoin, I am so happy.
Everything's
the
going
only
up.
thing I got wrong yesterday is I expected there to be a little bit more of a pullback at like $45,000. That didn't happen. I was wrong. We actually shot straight up and hit an all-time high of $47,000. Well, 48.
Whew, I'm just checking it right now because this video is probably a day old, and it just goes to show you how fast things change. And Ethereum's up to 3,500, Bitcoin's at 4,800, thousand, and XRP, what I'm holding the biggest, is almost 90 cents, 89 cents. Cardano 125. Yeah, everything is looking up. I mean, I bought so much I didn't catch the bottom. Let me see. So as far as, I don't want to say I caught the bottom, like Stellar XLM, I caught that at probably 19 cents. I remember when it went up to 74 cents, and I was just like, nah, that's too risk, that's too high. So I got about 10,000 of Stellar itself. So everything I do, I try to do it at 10,000. Like, I don't know why, that's my number.
$8,000 for this week. Bitcoin is still looking pretty healthy to me. Yes, there could potentially be pullbacks, and if we do get one, I would play the EMA 9 here and look for a pullback approximately $45,000 to approximately $44,000, because we are starting to get a little bit toppish here on the 12-hour chart, and we did have a nice run up. And you need to see a little bit of a pullback for posterity. Taking a look at the 6-hour chart,
I think you do need to see a pullback, but the thing about it is I feel like everybody was at that stopped investing, that took their money out, their money was out. And once things start to pick up and they start to run, people start to run into the market. And that's the thing. Like, can it go lower? Yeah. But that's why you dollar cost average in.
chart. 6-hour chart is looking okay. However, we're starting to get a little bit flat. So do expect for some volatility.
I'm not gonna lie, I get bored when they do these things. Like, I'm here for the information. Like, the whole chart thing is just, it's not for me.
Now let's go ahead and talk about Biden's 2023 budget that would hike taxes on the ultra rich, corporations, boost defense, and public spending. I'm not trying to get...
Bring back Trump. I said it. Bring Trump back, because y'all ain't about to start raising taxes when I get rich. That's all I'm saying. Y'all better quit playing with me.
Too political here, but I just kind of remember people saying that we needed to defund the police, and now all of a sudden we want to go ahead and fund them more. That's not really sitting well with me. Whatever, though. Let's get to money. Money is the most important thing. So if you go ahead and you read through some of these propositions that are going to be proposed, they want to go ahead and add defense spending, $6.9 billion directed at NATO, more than $32 billion in spending to fight crime at home, including more than $20.6 billion at the Justice Department and another $3.2 billion for state and local law enforcement.
It's terrible. It's ridiculous. Like, that's all this country does is spend money on, defense. Don't nobody want no smoke with us. Like, we can't, like, what are we doing?
Roughly $10.6 billion for global health security for future panoramas. And some of the key revenue raises here. They want to go ahead and raise corporate tax from its current rate of 21% to 28%. Let's talk about this a little bit, because a lot of people might not understand how this works or may disagree with me, and that's okay.
But before she says what happens when that occurs, I believe the thing about raising taxes on, like, when you do like corporate stuff, they just pass that on to us. Like, if you raise corporations, they're not going to say, all right, we're going to take a 7% hit on taxes. No, they're just going to pass that on to the consumer. So if the corporate tax rate goes from 21% to 28%, that just means these cameras that you're buying, they're going to go up another 7%, because they're not going to stop making money just because the government needs its taxes.
Comment your thoughts below. But corporations do employ people. So when corporations are receiving additional rate hikes or increases in taxes, that money that could potentially go to pay their employees better would now be going to the United States government.
Cap. I don't believe that. People, it's not like companies can't afford to give customers people rates. They just don't want to. So that, yeah, I'm gonna say that's cap, because you can see it right now. Like, literally before the pandemic happened, everybody's pay rates was like $7, $8, and then once there was a shortage, now they starting to pay $15. So it's not that they can't afford it; it's just that they didn't want to pay it. And then the thing about it, if you pay people more money, especially the lower class, they spend more money. So it's a revolving cycle. So I never understand it, but it is what it is.
That's not sitting right with me. What I would do if I was the president of the United States is I would say, you know what, we're going to go ahead and take this additional raise, or actually you need to account for this raise and you need to increase the amount of money you're paying your employees. There's no reason at all that the United States government needs to have more money coming in taxes until they get their spending under control. Now, taking a look at this story, Brits go wild over crypto as UK government prepares to disclose its plans for regulation in weeks. So UK government is saying we're going to have some sort of crypto regulations that will be coming. Pay attention to that. I think that they're going to kind of follow suit what the United States is doing. They're probably going to have some sort of working group that's going to focus, pay attention to what's happening. But either way, crypto regulation is going to be shown on a global scale. And this story here, Russia's deputy energy minister urges to legalize crypto mining as soon as possible. Well, there's a lot of sanctions being put into play regarding Russia. And Bitcoin is for the people, by the people. Whether you like what Russia is doing or not, people of Russia do deserve to have access to Bitcoin because it is a true decentralized economy. Interesting how that works, right? But I think it's important to note that they are going to start really kind of diving into Bitcoin and crypto a little bit more. And whatever type of decision comes out of this is going to be a little bit shocking to a lot of people, me as well. And I think the United States is going to have to react. So is NATO, so is all these other countries. Because if Russia all of a sudden adopts crypto and Bitcoin and becomes super bullish on it, and the United States and other countries don't, it's going to create a lot of strife. So I'm going to be following this story, and I will make sure to report to you.
Get interesting.
Lastly,
Good morning.
Well, not lastly, but Arby's wants to offer virtual food in the metaverse. That's great. I love the metaverse. And also, too, Arby's is one of my favorite fast food restaurants. Lastly, if you were in LA, please make sure to drop by the free NFT.
Wait, we're gonna start right there. Like, what are you talking about buying food in the metaverse? That's, I ain't gonna hold you. I did want to, oh, did I cut out? Oh, I did want to buy some land in the metaverse. Everything is super expensive. And from what I hear, that's going to be like in the future, that's what people are going to be doing. They're going to be focusing on pretty much just not going out as much. They're going to put that little headset on. Hopefully it'll become glasses by then. I mean, not hopefully. I would encourage everybody to go outside. Life is beautiful outside the house. But that's what they're saying the future is going to be. For you to get fly, you're going to be dressing, buying clothes in the metaverse that you don't even own, which to me is kind of ridiculous. But that's neither here. So it is what it is.
LA meetup tonight from 5 to about 10 p.m. I will be speaking alongside Meta Money.
Let's see who else we got, because we got like just 2 videos, 2 short ones. This is the next one.
The market is a device for transferring money from the impatient to the patient. This is kind of a proverb.
Okay, so this is the second and last video we're going to react to today. It's called Proof You Should Never Sell Your Crypto, which, you know, I'm not leaving. I'm not fucking leaving. So, yeah. Yeah, everything went up this weekend. We'll get into it right now.
Reminding us that temporary downsides aren't an obstacle, but a necessary stepping stone towards maximizing profits. Buffett, of course, was talking about the stock market and wouldn't touch crypto with a 10-foot pole, but the question remains, does it ever make sense to sell? What does the research actually say? Hodling is more than just closing your eyes and white-knuckling it until CoinMarketCap turns green. There are 2 main reasons why you'd never sell your crypto. 1, you believe in how the project will come to define the future of the global economy, and 2, you want to make money. As much of it as you possibly can. And I don't judge either way, you do you, but hold on a second, because it's too easy to yell HODL, dollar cost average, and buy the dip. It's never quite that easy in practice. So instead, I want to arm you with the knowledge of strategies that you can take and how they compare profit-wise. This way, you can sleep a little bit better at night knowing that the crypto in your wallet deserves to be there. It's pretty clear that crypto hasn't managed to shake stock market moves. Fears in the stock market almost always translate to fears in crypto. That is in the last 2 years anyways. Whether it makes any sense or not, that's how things work. It's also true that altcoins rise and fall based on Bitcoin's performance. I like to think of it like gravity. So let's picture Bitcoin as the sun. Small altcoins are then planets that are affected by Bitcoin's mass and movement. But if Bitcoin is the sun, that makes the equities markets like the Milky Way, whose even larger gravitational pull can sway even Bitcoin. Sure, hype, FOMO, or the occasional tweet from a billionaire can allow a project to break free from the gravity for a while, but gravity is a big and it always wins in the long run. The good news is that some projections put Bitcoin reaching $200,000 in the second half of 2022. They literally call it a powder keg that could explode to 5x based on the fact that 75% of Bitcoin's total supply is being kept in storage. Basically, the thought is that there's such a limited supply of available Bitcoin, it would take an institution just purchasing 200,000 Bitcoin to increase the asset's value by at least 3 times. Now, predictions don't always work out, and that one in particular is banking on someone dropping nearly $10 billion on Bitcoin. But if they do, you'll want to know this: the best days theory. And this isn't the theory saying that you peaked in high school. This theory says that you shouldn't try to time the market. But why? It turns out that if you miss out on the 10 best performing days in an asset's history, your return is dramatically decreased. In fact, this can actually take your return from positive to negative. Take a look at this chart. In the 1980s,
And this is something that Warren Buffett has said before. Like, and you know how people feel about Warren Buffett. He's the OG of the whole investing space. So this is pretty much, that's why you don't try to time the market and people trade in and trade out. But the thing about it is, you know, you miss 1 or 2 of these days and you're talking hundreds and thousands of dollars you could have missed out on.
the S&P returned 227% over 10 years. By my math, there's more than 3,000 days in a decade. If you missed out on just 10 of the biggest gainer days, your return for the entire decade is more than cut in half. Short-term traders in crypto will argue that day trading is the only way to make real profit in this market, which, don't get me wrong, that can work, especially if you're really familiar with one asset and its price movements. But this,
I never understand that. Why would you want to do that? Like, it's a small percentage of people that make money on trading at that. And then the thing about it is, just like I said, if you miss out on one of these days, or even worse, the market drops while you're trying to trade. I mean, you could have spent years building up your portfolio and you see something like the Rona that came and then the stock market crash and you sell out at the bottom thinking that it's going to keep going lower and it comes back up. Like, it doesn't make sense to me.
This underestimates the time it takes to really watch and study market movements.
And I used to do that. Like, when I was younger and in college, I was trading penny stocks. And I tell you one thing, it was a lot of work. I mean, I missed going to parties and stuff, like just trying to do as much research as possible on these things.
Not to mention the stress. For a trade to be worth you spending all day staring at a screen, it has to be a dollar amount that's significant to you. That's stressful. I mean, my heart rate is already high enough sitting here drinking coffee all day long. You know, this works for some, but for most people, that's just too much emotion to fit into your average Tuesday. So it seems for a normal human, time, not timing, is what matters most over the long run, which is great because that's actually less work. I mean, who doesn't want to do less work? But there are different levels of passively hodling. A few studies have come out that challenge the idea that holding through thick and thin is the best. The best days theory works because we have stock data all the way back from before your grandparents were born. Newer strategies have come out that may outperform the white knuckle fever dream that passive holding can be. So a study by Investopedia compares the buy and hold approach to a more active strategy called constant mix. Here's how the study was set up. Group 1, the hodlers, would buy an allocation of stocks and bonds at a 60-40 split, just a classic stock and bond allocation, and hold them no matter what happens in the market. Group 2, the constant mix, would buy the same 60-40 split, but then they would constantly rebalance to keep the portfolio right at 60-40. If stocks go down, you'd move some bond money over to the stocks to get that back up to 60%, and vice versa. You get it. What's important is the results. They were peculiar. It turns out that in a long trending market, whether up or down, the buy and hold strategy has a better return. But it gets more complex in an oscillating market. This just means a market where things are more unpredictable. You know, big reversals followed by big surges in price. When things are crazy and unpredictable, constant mix actually beats out hodling. The reason being is we're emotional. This is also the reason why I've been trying out one of those, gimmicky like beard roller things, because I'm getting tired of being cyberbullied for my patchy beard, and I'm just trying to do everything I can about it. But either way, this strategy essentially systemizes buying dips and selling profits while completely taking out those pesky emotions from your decision making. The reason I bring this up is an oscillating market sounds a whole lot like crypto in general. An uptrend over time but a whole lot of volatility along the way. So if your goal is to maximize your profit, it seems like committing to a portfolio balance could be the right way to go. So I sat there and I thought on this for a while. How could this strategy be applied to crypto? See, it works well for stocks and bonds because those assets typically move in opposite directions. When one is doing well, the other typically isn't because they're essentially fighting for the same dollars from investors. So I was trying to figure out what does well when crypto is down, because you want to be in crypto, but again, Bitcoin's gravity means altcoins move in the same direction, so it's not quite the same as stocks and bonds. And then it hit me. Lending. It's not the exact same, but the principles are similar. This rebalancing strategy could work extremely well with lending and holding crypto of your choice. You could, for example, lend out 40% of your portfolio in stablecoins for 10 to 20% interest, and then the remaining 60% be in cryptos of your choice. Then every 2 weeks or once per full moon or however you want to do things, you rebalance it back to that 60-40 split. But it doesn't end here, because we have another study by Shrimpy that goes even deeper. And this time it's specifically a study on crypto. So here's how it worked. They took crypto from the bear market between January 2018 and January 2019 and built portfolios of cryptos ranging between 2 and 18 random assets. And each of those 5 portfolios were duplicated and rebalanced over different time intervals ranging from 1 hour to monthly.
Some people got too much time on their hand, Lord Jesus.
The goal was to then compare those 20 portfolios to the results of the same cryptos with no rebalancing whatsoever. So baseline performance versus rebalancing. Not to sound like a BuzzFeed article, but the results were shocking. The clear winner by a huge margin was daily rebalancing. It did best for every single portfolio size and significantly better than holding outright. The percentages shown here is the performance over simply holding the same cryptos. What they found is the more often things are rebalanced, the better. However, there is a speed limit, because the more you trade, the more trading fees you incur. This is why hourly rebalancing perform worse than daily. And they also found out that the more assets you hold is also generally better. Now, it is important to note that they chose random cryptos, so your portfolio may end up with completely different results. But the question is, should you regularly rebalance your portfolio? And chances are, it wouldn't hurt. And thankfully, it's the 21st century and you don't have to manually rebalance yourself every day if you don't want to. Pionex has a bot that auto rebalances your portfolio with up to 10 different coins. Here you click Rebalance Bot, multi-coin mode, customize.
I'm not even gonna hold y'all. I have no idea what the hell any of this is. Like, I don't know why you would want to rebalance. Like, I mean, yeah, I don't know. It's pretty interesting. I'm not, what I'm buying, I'm holding. That's it. I'm not going to keep trying to do all these things. You got to live your life. Like, and I mean, I understand they got this, that. I don't know.
Choose your favorite crypto gems. Choose how much you'd like to invest. Click Advanced Settings. Turn on Rebalance because that's why we're here. And then you can see that they only go up to 4 hours, which isn't a big deal because their fees are super low at only 0.05%, but you can limit that even further by changing the rebalance mode to threshold. There you can allow the bot to only rebalance after set price changes. So ponder what you'd like to do and click Create. And then from there, you can click Detail and see everything you need to know about the portfolio. It's pretty darn handy to use, and I'm going to use this bot and just see how it does. Pionex will also be linked in the description. If you use that link, you'll get even lower trading fees. But all of this leaves us with one glaring question. If it's best to just buy and hold forever and perhaps rebalance, when should you sell? I mean, at the end of the day, the point of investing is to make money and then do the things you want to do with that money.
I'm going to use this crypto and I'm going to take loans against the profits and we'll see. But for the most part, I'm just banking on most of the stuff being retirement plans. Like, y'all got your 401ks. I'm going to hold on to my stuff. And then I've got some dividend stocks and we're going to go from there. I mean, on crypto.com, I got the interest rate going from there. So maybe I could sell some of that stuff like that I make off the interest, but we'll see.
I mean, I still got my eye on that 18th century samurai armor. But what if I told you that it's possible to do both, to hodl and buy 18th century samurai armor. There's a story of Larry Ellison. He owns 22% of this little corner shop you may have heard of called Oracle. His ownership here has made his net worth absolutely massive. But he has a problem. If he wants to use any of that money to, I don't know, get in the billionaire space race or whatever billionaires want to spend their money on, he has to sell his shares. What he did instead of selling was use his shares as collateral to take out a line of credit at the bank. A line with $22 billion.
Didn't I say that?
Limit.
That's what I said,
His strategy
right?
made him the most indebted person alive. But this does something interesting. It means he never has to sell his shares.
Right.
Meaning he never has
That's what
to
I
pay
said.
capital gains tax, and he still gets to use that money. The beauty is anyone can take this same strategy. It can be done pretty simply on most crypto exchanges, locking up some crypto and then borrowing against it. Or in DeFi, you can take things one step further. Take this example on the Yearn protocol. You can take the stablecoin USDC and deposit it for an average yield of around 7%, earning you money on your cash. When you deposit your USDC, it turns into YVUSDC. This is called a yield-bearing collateral, basically a receipt of your deposit that in itself is worth money and is making money. Now you take your YV tokens to the Abracadabra protocol, pledge them as collateral, and borrow MIM tokens against it, another stablecoin. Just stay with me here. What's great about this is that the interest that you'd have to pay on the borrowed MIM is way lower than your return on that USDC deposit. So theoretically, your yield sits at 6.2%, and you still have those stable coins that you can then use to buy more crypto, sell for cash, or spend however you like. Now, of course, this is an advanced strategy. Please do your own due diligence, and there is added risk if you're using collateral that has some volatility. But the point is, in DeFi, you can have your crypto and spend it too. So if you learned anything new,
I see what you did there. Have your cake and eat it too. Have your crypto, eat it too.
don't forget to hit the subscribe button. It's free, and you can all.
That's my guy Max. I watch a lot of his videos. I think that's pretty much all I got for you guys. Appreciate y'all rocking with me. Hit the like, comment, share, subscribe, and I'll holla.